funding winter in Indian startups continue to linger on, and I think it's an important story because we've been discussing how FPIs in India is increasing, but at the same time, startups continue to dwindle in absence of enough foreign funding.
So Shweta, this is not something that was completely unexpected, but such a massive dip, 72%, is not something that many people had expected, me included. Now, what happens in an economic cycle is that, why do VCs really take a punt on startups? VCs take a punt on startups because they believe somewhere down the line there is going to be another round of investment, which is going to make their original investment far more valuable, and they're able to withdraw and make a quick buck.
Okay.
Now, of course, investing in startups comes with its own set of risks as well. So, what happened with the high inflation in the US and interest rate being, taken higher and higher in every consecutive month by the US Fed, it just made investing in the US Treasury a far more lucrative option.
Okay.
So what startups do is, at a time when they see that there is global uncertainty, when they realize, when VCs realize that it may not really yield enough rich dividends, sustained dividends in an environment where there are talks about recession, where there are talks about an overall inflationary environment, and it becomes a little unviable for VCs to take those risks on a sustained basis, as a result of which they decide to hedge their investments by parking money in a safer haven like the US. And that is exactly the cycle that we have seen. Now, the numbers are quite interesting actually. You've seen total investments, and I'm talking about foreign direct investments through VCs into Indian startups.
Yeah.
They have dipped from a 16.2 billion to about 4.58 billion. So this is a massive decline. Yeah. So this is a massive decline. And what are the headliners? The headliners include Accel, Sequoia Capital, Tiger Global, SoftBank. These are all major investors who have taken part in the Indian startup ecosystem. They have built or helped build companies like all the unicorns that we know of, from the likes of Flipkart and Ola to Daily Hunt and what have you. So these companies have sort of taken part in building, fostering the Indian ecosystem. And then suddenly they realize, like the rest of the world, that startups and their journey to profitability is often a long run one.
Okay.
So does it make sense to stay invested and keep pumping in dollars without a potential high value exit? And I think the answer they arrived at was no. And hence, the funding has dried up. So globally, it's not just India.
In fact, I was about to come to that.
It's a global funding winter.
Is it specific to India? We understand viability of startups is a question mark, not just in India, but many other countries. But in India specifically, we're looking at a 4-time decline over a course of 1 year, which was 365 days. Is there something that triggered that decline in terms of a policy move or a big startup going under, or is it gradual on expected lines?
So see, good question, Shweta. You have seen Byju's, for example, plummet like no tomorrow. It was a business that was built in the thick of the pandemic. It had enormous number of takers. It was raking in dollars. It had hired enough and more people, which again became a little redundant once schools started reopening. So that could have been one of the potential triggers in the overall environment of startups, right? And EdTech as a whole, I don't want to single out Byju's, but EdTech as a whole has taken a beating, right? But I think to answer the larger question, this problem is not India specific. The funding winter has been there in the whole world for exactly the same reason, that startups will take time to return profitability. They will take time for your capital to appreciate, and another equally powerful, potent VC coming, investing at a higher valuation that an existing VC can cash out and make his or her money.
Right.
But I think the challenge really was that with the economic downturn, the potential economic downturn, with inflation, with the Russia-Ukraine war, with China's sort of supply chain hit with the zero COVID policy, overall the boom that was there in startups during the pandemic has taken a complete beating the world over. And that is the reason why VCs are pulling out, and they have thus far been investing in the US bond market, US treasuries.
And we've seen a sustained effort by investors to push startups to, you know, even if they have to scale down operation, to come up with profits on their books. And you know, we've seen this in case of unicorns, and we've discussed this widely, how big numbers are less important than profits on the book, even if a company is not a unicorn. And we've seen unicorns declining in 2023 so far. In 2022, we saw many unicorns in the first half, almost 6 to 7 in the first half. No unicorn entering that club in the second part of 2022. So essentially, as from what I understand, the bigger thrust here is for profit on books as opposed to scaling up of operations, going big with numbers. You need to be able to make money in order to sustain. It doesn't matter if you're big or small.
So it works both ways. There are cases where profitability is elusive for a very long time. But if you look at the last 10 years or so, VCs have continued to invest in those businesses. Why? Because those businesses are working on scale.
Okay.
They're working on innovation, new product delivery, new vehicles of delivering a product or a service. But at the base of it has been a large customer base that needs to be acquired. And once you've acquired a large customer base, the thinking in the VC circles is that sooner or later profits are going to follow. So the pressure on profitability has not been as high as the pressure on scale from VCs, because they feel there's no point getting a 5%, 8% profitability right now. It's better to capture the market. Go carpet bomb, get as many customers as you can, burn cash in the meantime, that's all right. You know, spend on advertising, do big ticket technology spends, no problem at all. Carry on carpet bombing, capturing the market, and profits will follow.
Okay.
But again, how long are you going to take those risks? And the risk is not only on profitability versus scale. The risk is, am I better off today investing $100 million in a startup with a lesser likelihood of another VC coming and valuing the same investment at $200 million, and I can walk away with a $100 million profit, rather than invest it in a safer option like the US bonds with a yield of maybe 6%, 8%, and draw in at least, you know, some sort of a return on that investment, rather than parking money in a place that may not yield something significant in a near term.
Okay, and before we move on, while there is absence of easy money now, many startups in India have also shelved their IPO plans. And I'm looking at a list here: Boat, Go First, MobiKwik, VLCC, Oyo. It's not looking too good right now for startups in India. And how long do you think is that going to continue? Because this has been a prolonged funding winter.
So again, you know, startups that find easy money will continue to get easy money.
Okay.
But easy money beyond a point dries up for everybody. Now, when you list on the markets, scale is not the only thing that the retail investor or the institutional investor is looking for. Markets are very clear. They want a clean P&L. They want a very robust balance sheet. They want a good order book, right? We've seen in the case of startups that did go ahead and list. Look at Paytm, look at Zomato, look at Nykaa. These were three big startups, among the biggest, in fact, in India, right? All unicorns. They listed. And what happened? They didn't have profits on their books. They didn't even have actually a very clearly defined business model, so to speak, especially in the case of Paytm, if I can, you know, stick my neck out and say there wasn't a business model. Markets understand those patterns, and markets start getting very spooked if they see too much red on your balance sheet or on your P&L. At the same time, Paytm also had other problems before it listed, which was infusion of capital from Chinese-based investors, which came under the government's radar, and then obviously, you know, there was the whole issue around that. But investors, when you list on the market, want to see profits on the books. They don't understand the game of scale and carpet bombing and capturing the market. Now, there was also a time when a lot of tech startups preferred to list in the US as opposed to listing in India. And Flipkart was one of them. PhonePe was contemplating that. And many other startups in the tech space wanted to list on the NASDAQ, which is known for technology listings, rather than list on Indian markets. And at that time, there was, I'm talking about 2021 or so, there was also this blank check company concept called SPAC listing, through which a consortium of investors would form a special purpose vehicle and your company becomes part of that SPV that lists on NASDAQ. There was great excitement around SPAC listing, but US markets have also taken a beating. So at a time when companies that are contemplating listing but are not sure of the economic environment in the US, with a recession likely to be underway,
And a
we've been
lingering
talking about
debt
it almost
crisis.
every day. Debt crisis has finally, I mean, you know, the
Yes.
negotiation has closed and there has been an up in the debt ceiling. But at a time when you don't know which way the markets are going to go, will you want to risk listing your company at a time when markets could actually tumble and crash on a NASDAQ sort of an exchange? Many people don't see value in that and I cite them for that. Maybe it's better to wait it out, let the downturn, if at all it ever happens, hit the rock bottom, and when things start to look up, that is when look at an international listing.
Okay, listing there is on hold for a lot of Indian startups, and given that the market is not allowing them to list so easily, it is becoming increasingly difficult for many of these big startups, for that matter, from MobiKwik to VLCC, to be able to go ahead with an IPO. We will of course keep tracking that story.